Hey there, welcome back to Retirement Intel. I'm Jonathan Rankin, and we are back. Took a little bit of a hiatus over the past week and a half, but we're back with a special Thursday edition where we're going to be going over whether or not, once again, is the 60-40 portfolio going to ruin your retirement? And then we're going to talk about what's going to happen to you and your retirement if the Trump tax cuts expire, as they're set to do so. And so we're going to break all of that down. We're going to spend some time going through each one of those things, but I'm happy to be here. Thank you for joining. If you're here with us on the live, make sure that you hit that subscribe button. Do me a favor, if you've got questions as we go through this, use that live chat feature. We'll be happy to answer any questions that you got. But I'm happy to be here. I'm excited to go through this stuff with you. It's been as we've all seen, it's been a wild week on the political front. So as you've known, this is not a political show. But we're definitely going to dive into the Trump tax cuts and those expiring and how that can impact you. But first, I want to touch on an article that I recently came across in the Wall Street Journal. Now, the article was titled, "A Time-Honored Strategy Puts Your Retirement at Risk of Financial Ruin." And so they're talking about, as the subheadline reads, the tried and true 60-40 portfolio and 4% withdrawal rate in retirement could lead to catastrophic outcomes if markets behave differently than they did in the past. Now, this is something where I don't know when this happened, where the 60-40 portfolio became as polarizing as talking about politics at the Thanksgiving table. I just don't get it. Because there's another headline that was out from Morgan Stanley that said, big picture, return of the 60-40. So on one side, you've got 60-40 is back. That's the way to invest. On the other side, you've got, hey, this is going to lead you to financial ruin. So what is it? And why is this such a topic? So, we're going to break down exactly what they're talking about in this article, but I've linked to it in the show notes. Make sure you check that out. And I've also got a link there to our upcoming special webinar where we're going to be talking about the election, the impacts that can have on the long-term economy. So if you want to join, make sure you register for that. That's going to be a registration link that you've got to click. And then we've also got a link down there to where you can schedule some time with a member of our team. We'd be happy to put together a retirement plan for you. There's no cost to go through that, but making sure that you're on track for retirement is obviously a big part of what we do here at the Think Retirement channel, and our focus is to help you get to retirement. So let's dive into this polarizing topic of whether or not the 60-40 is going to ruin your retirement. And what they talk about is, the fact that the way that returns have been over the past couple of years, and what returns are going to be expected moving forward aren't what they were back in, the 90s and the early 2000s. But what does that mean? Could it actually ruin your retirement? Could a 60-40, when I think of ruining retirement, and when I talk to clients about this, ruining retirement is not going to be based on a 60-40 diversified portfolio. Ruining of retirement is going to be because there was overspending, there was lack of planning. There's a lot of ways to ruin a retirement, but investing in a 60% stock, 40% bond allocation, as long as it's well diversified, that's not going to be what leads you to financial ruin. Because the way that you're going to get to ruining your retirement is going to get to a point where obviously you run out of money. But that's something that you should be able to identify years in advance and not just find out, and wake up one day, go, guess we're out of money. So that's really the big part of when I see financial ruin. It's not about, thinking about how a portfolio is going to last for 10, 15, 20 years. If you've ran out of money, it's because there wasn't ample planning that's happened between now and then. But when we look back, the 60-40 portfolio finally got back to even earlier this year after one of the worst years on record in 2022. That was, when we compare that to, the other worst periods that portfolio had, in 1974, it was down, well over 20%. Stocks were down at that point in that year, 23.5%. And then bonds were down about 3.6%. That's what contributed to that close to 25% drawdown. 2022 was a little different. It was split more, a little bit more evenly, where stocks were down 13.8% for the part of that portfolio, and bonds represented a 9.1% loss. It was one of the rare years where we saw a correction in both stocks and bonds. And so it was a really tough year in 2022. One of the toughest that I've seen since 2008. And so, when we look at how to manage this moving forward, it's important to start thinking about when you're building out that 60/40 portfolio, what does this really mean? When they talk about a 60/40 strategy, it's 60% in diversified stocks, 40%, the benchmark is using just, standard bonds. And so that's really where this is, where the article is talking about could be the bigger issue, is that, back in the 70s, bonds had the opportunity to drop from, a much higher rate down to 1.5%, which would create much more of a gain than where the 10-year treasury is at today. And if it were to drop to 1.5%, because the 10-year treasury is not where it was back in 1974. And so that kind of brings us to the relationship between interest rates and bonds. As bonds, as interest rates go, so if interest rates are going up as they did in 2022, the reason why bonds really suffered is because as interest rates go up, bonds go down. On the other side, and this is what a lot of people are anticipating, as interest rates go down, which is what the Fed is expected to do next week or start that process, then the value of bonds should be going up. But it's the magnitude of that change that they're attributing to within the article. And so, what they're really attributing to is the risk of owning bonds, and they're talking about missing out on stock returns as well. But the interesting part is that they do mention that, in the article, that one of the risks that they talk about is owning a lot of bonds, and this is a direct quote, means settling for lower returns, which is another form of risk. So they're just pointing out a bunch of risks altogether. After all, $100 invested in the stock market in 1928 turned into $787,000 in the beginning of this year, more than 100 times as much as owning treasury notes and 350 times as much as owning short-term treasury bills. Now, I get that. I think anybody who invests in anything understands that over the long period of time, stocks outperform bonds. But where the 60/40 comes into play is to help alleviate what is known as sequence of return risk. If you're getting ready to retire in the next few years, the reality is, if you're taking money out of your portfolio and you see a large drawdown in your portfolio at the same time, it just compounds that loss, especially in the early years of retirement. And that's one of the biggest risks to retirement, is that sequence return risk. And that's where the 60/40 rule comes into play. Is that it really helps buffer that. So if you're not familiar with sequence of returns, it's something that you really want to pay attention to if you're getting ready to retire, especially with where stocks are today and the valuations that we're seeing. They're a lot higher than what they've been. And if we look forward in the next 6, 9, 12 months, if you're looking to retire, you want to make sure that you're implementing something like the bucket strategy to protect if we do see any large drawdown in the markets. But to avoid the sequence of returns, that's how the 4% rule was born. And what I loved about this article is they decided to just attack everything. They attacked the 60/40, they're attacking the 4% rule. And if you're not familiar with the 4% rule, that's the rule that says that a retiree can withdraw 4% from their portfolio in year one and then increase that by inflation for the next 29 years with very little chance of running out. Dates back into the 90s. And so they go on to attack in this article the 4% rule, saying that it was based mostly on, as they put, preposterous and peaceful period of America. So even so, a person retiring in 1966 ahead of a bear market and a spike in inflation cut it very close. So they're citing that there's a study done that looked at 38 developed countries over the course of a few decades. So it was a long period of time. And what they looked at was that the study determined that a retiree who wants no more than a 1 in 20 odds of financial ruin, they could only withdraw 2.26% per year. So now, I've heard of 4%. I've heard the rule go all the way up to 6 or 7%. And now clearly it's down to 2.26%, according to one study. But can we just stop? I'm going a little rant here. Can we just stop with the predetermined withdrawal rates? I don't care what the number is, 4%, 2%, 3%, you pick the number. Have you ever determined anything in your life that lasted for the next 20 to 30 years and never changed it? I can't think of one thing, that anybody has ever just predetermined day one and said, I'm just going to set this and I'm never going to change it. That's a big flaw. If you're just saying, I'm going to take 4% out, there's never been something in your life that you started. And most likely, if you're retiring, you're going to be in your 50s or 60s or maybe your 70s. So you got to this point after 5-6 decades on this earth. And my guess is there hasn't been a single thing that you've stuck in stone to say, this is what I'm going to do, and I'm not going to change it. So I'm a little over the set it and forget it type of planning and using these type of rules, but hey, I digress. So that's where, if you're basing your retirement on any sort of one rule, it's important to make sure that you're planning yearly. That's the way that I look at it. That's at the very least. For people in retirement, we always like to make sure we're updating retirement plans at least a few times per year, just to make sure with where the market's at, with how spending's going, that we're on track, for that year and being very flexible. But the biggest part of this article where they talk about the issue with the 60-40 is that the worry is that the 4% rule has almost always worked out over a period when a 60-40 portfolio has earned an average of about 9% a year, or as they put it, a real return of 5.8%. So after inflation. But the issue comes into play where Robert Shiller's cyclically adjusted price to earnings ratio is now more expensive than it has been in 97% of the time since 1880. And what they're calculating is that the expected return over the next 10 years is only 3.86% for stocks. So when you minus inflation over the next decade, that only comes out to 1.65%. So they're looking at this as we're going to have lower returns in bonds because there's not much of a difference between where the 10 year is at and 1.5% as there was back in the 70s. And they're using Robert Shiller's price to earnings ratio to determine that, over the next 10 years, we're likely not to see rates of return like we've seen in the past, that are going to get that portfolio to a average rate of return about 9% or a real return of 5.8%. So my favorite part of this article by far is the last paragraph, where they say, even if a retiree is completely confident in the 4% rule, it was devised at a time when Social Security was seen as rock solid. The latest report from the trustees of the Social Security Fund calculates that monthly benefits will have to be reduced by 21% in 9 years when the trust fund is depleted. If personal savings are needed to plug that lost income, then someone retiring soon should consider preserving capital or saving more. So let me get this straight. This article is attacking the 4% rule, the 60-40 portfolio, and now Social Security. The only thing missing here is the scare of rising healthcare costs. What else? What other fears are they missing out on attacking here, or rules of thumb? Maybe you need more or less than 80% of your pre-retirement income. I just love how they have to attack every type of general rule of thumb or retirement topic that is on everybody's headline. Yes, is the 60-40, could it face some issues moving forward? Yeah, I mean, we went through a lost decade from from 2000 to 2010. So there's periods of this market of investing that have not fared very well for many people, and that's why it's important to make sure that you're not just setting a 60-40 portfolio one time with a 4% rule attached to it and just not touching it and addressing it for 20 or 30 years. It's important that you're always planning on what's going on in real time in that year and adjusting accordingly. So I think that there are going to be some tough stretches moving forward as we're starting to see a little bit of deterioration in the economy. But that's where I think security selection, sector selection, can also prove to be key to, look at markets that, are pockets of the market that are, relatively, a good value compared to an expensive, as Robert Shiller put it, expensive market overall. So I just love articles like that. You probably find them yourself where, they just start attacking every different rule of thumb or thought process that we all have probably heard about when it comes to retirement planning. And that's why it's important to just take those things for a grain of salt. I read articles like this, and I like the statistics they use. I like to hear the different arguments that are going on, but I also understand that there's no one size fits all when it comes to investing. I've got clients that are retired that are very comfortable with risk and want to take more of it. And I've got clients that are very conservative and want to take less of it. So, it's important to just base your retirement and your retirement portfolio on what you are looking to accomplish, not some general rule of thumb like, the 60-40 portfolio. Doesn't have to be that, and it definitely doesn't have to be 4%. So, all right, that's enough of that rant. We're going to move on to the Trump tax cuts. There's another article that talked about how the Trump tax cuts expiring is going to impact each individual and how that's going to look. And so, if Congress doesn't act by the end of 2025, then income taxes are going to go up for almost every single household. And that's what's going to happen on just the very general level. And once again, I think I've made this very clear on this channel. We're not a political channel by far. This is not, Fox or CNN. This is not what we're here to do. I mean, I think, I watched the debate like many of you, and we're probably left going, well, here we are yet again, 4 years of, 4 more years until our next, argument on a television screen. But hey, we're here. We all going to pick who we're going to vote for in November. But at the end of the day, it's, to me, it's about figuring out, okay, how is this actually going to impact, the clients that we serve and, in their individual goals. And so one of the things coming up in the end of next year is the expiration of the Trump tax cuts that went into effect. And so research shows that it's going to go up for everybody, not just, lower class, middle class, and upper class. It's going, everybody's taxes are going to go up, but it's the amount that they're going to go up that will vary based on, a number of different things. So let's just take a quick step back and look at, so what did the 2017 Tax Cuts and Jobs Act do? So at the time, it lowered rates overall, just lowered tax rates. And it created a larger, a bigger standard deduction, a larger child tax credit, business tax breaks, and relief from the alternative minimum tax. Now, it did increase in certain areas. It included the elimination of per-person exemptions, limited itemized deductions, and created a $10,000 cap on deductions for state and local taxes. So when we look at, we're going to switch gears and take a look at this real quick. It's a great chart by that was in the article. So if we look at, let me pull this up. Okay. So if we look at what happens if they do increase, so if the tax, if the tax laws expire and the tax cuts expire, it's going to be about a $450 billion net increase in taxes. So that's likely what we're going to see. It's going to be, net increase about $452 billion. You could see, the mechanisms based on each individual change that we've seen and how that's going to impact the overall number to increase taxes by $452 billion. So that's really where it starts. Now, the tax cut really helped top earners in states without income tax. So that's really where it helped out before. So in 2017, if you lived in a state, like Texas, where there's no state income tax, it really did help you if you were a high job earner. And when we look at, state by state, how this has impacted each individual, that's where we can see, I like the way it kind of breaks this down. You can see where the degree of, tax increases will be if they actually expire. So depending on where you live, you could see where your taxes are going, how much this impact if the taxes actually increase because the tax cuts go away, depending on where you live. So, here we're in Dallas, Texas. So we're going to see a higher increase because we've got no state income tax here. If you live in, Southern California or, in places in New York where tax rates are extremely high, then you're actually going to see less of a tax increase. Now, that doesn't mean it's not going to increase. It still will. but it's not going to increase as much. So, high household incomes could see the largest tax increases, but those places with no state income tax really see a larger across the board hit. And that goes back to the cap on deductions for state and local income tax. So, when you remove that cap, it's going to help out some of these higher tax states. Now, is this going to actually expire? And that's where, we'll not get political, but we'll talk about it a little bit. No, I don't think that they're actually going to expire. A full expiration of the tax law is not likely. There's Republicans want to extend it, Democrats want it to extend, but they want to extend it with income limitations. As you can imagine, for higher income earners, they'd like to, reduce the tax cuts for high income earners. But all in all, I don't think either side wants to see taxes increased for any individual out there, especially across the board, as this would do, because it would increase it regardless of what your taxable income is. It was interesting because in the article they talk about, for retirees, they point to Collier County in Florida. A full expiration of the tax cuts would mean a tax increase of about 3.8% of adjusted gross income. And, there's also the estate tax exemption that's also going to reset. And it's going to, it was increased to $27 million for a married couple. And so, if that's something that if you're above that limit now, you're getting close to it, and it's something that you might want to start looking at, really putting together a real clear estate plan, making sure you're doing all that you can now to, just focus on protecting what you can. But so what can you do with this? Obviously we don't know what's going to happen. We just know this is on the docket, that tax cuts, are coming to an end, most likely, unless something's done about it. But my guess is that it's just like, the fiscal cliff that we, hear about every year, it seems like, where they have to increase the debt ceiling, or else we're just going to shut down the government. Always never makes sense to me, but they always find a way to make it happen at the very last minute. Now, I think something like this, regardless of who gets in the office, is likely going to extend in some form or fashion. But depending on your income, what you could start doing is start thinking about what expenses you could cut if your taxes do go up. Going back to that couple, that married couple that's in Collier County, Florida, 3.8% increase in taxes. Start thinking about if that's going to impact you. If let's say you're on a fixed income, and that 3.8% is a meaningful amount, and that's going to negatively impact, what your spending is, then maybe start putting a plan together now for what could you start cutting, what expenses could help make up that difference there. So nothing's set in stone at this point. So don't think that your taxes are going to increase when you file, in April of this next year, but it's on the docket, something to at least think about. With all this, don't make any rush of judgment with, abandoning your 60-40 portfolio if you're watching earlier, or, going out and, selling everything because you're worried about taxes increasing over the next year. Feels like there's a whole lot of time between now and even November before anything, before the actual election. There's a lot of time, it seems like, between now and when, any tax changes could actually happen. So if you have questions about how those things might impact you, or other questions about how, the election could impact the overall economy, make sure that you register for the webinar that we've got coming up on September 23rd. There's a link to that webinar where we've got, a special guest economist that's going to join us and talk about, how the election outcome could impact the long-term economy and what to look for there. So register for that. But if you have questions about your specific circumstances, use the link in the description below, and let's schedule some time with a member of our team. And we'd be happy to talk to you about putting together a very comprehensive retirement plan for you. Have that call. We don't charge anybody. It's just to have a conversation, see where they stand, how we can help solve their problems if we can. And, be happy to talk to all of you. So I appreciate you taking the time joining. Make sure that you hit that subscribe button. Join us every single week. This was a special Thursday episode, so thank you. I apologize about the absence over the past week and a half. I was out of town, and the goal is that we're going to be back on Tuesday every single Tuesday, 4 p.m. Central. We're going to be live. And so thank you for watching, and I will see you in just a few days.